No taxes, free land, and a factory that prints profit. When investors saw Tesla's latest manufacturing deal, the reaction was not excitement. It was shock, because this is not a subsidy. This is not a discount. This is a structural advantage most companies are never offered, and it changes how Tesla grows forever. Why this deal stunned investors. Factories are supposed to be expensive. Land costs millions. Taxes compound every year. Local governments negotiate from a position of power. That is how it usually works. Tesla just flipped that model. Instead of paying to build a factory, Tesla was invited to build one. With no property tax burden, land provided at zero cost, long-term incentives locked in from day one for investors, this was not just good news. It was unsettling, because taxes and land costs are not small line items. They are structural drags on margins for decades. When those disappear, something rare happens. A factory becomes profitable before the first product ships. This is why analysts stopped talking about production capacity and started talking about leverage. Tesla is no longer negotiating as a company asking for permission. Tesla is negotiating as an economic engine cities compete to host. And once that dynamic flips, growth stops being constrained by capital. It becomes constrained only by execution. How Tesla negotiated from power. This deal did not happen because Tesla asked politely. It happened because Tesla no longer negotiates like a normal manufacturer. Most companies approach governments with a problem. They need land, they need incentives, they need approval. Tesla approaches with a solution: jobs, infrastructure, energy investment, and long-term economic gravity. Governments understand something investors sometimes miss. A Tesla factory is not just a factory. It attracts supplier ecosystems, skilled labor, migration, housing development, grid upgrades, transportation, investment. The tax revenue does not come from the factory itself. It comes from everything that forms around it. That is why governments are willing to give up property taxes and land costs. They are trading short-term revenue for long-term dominance. Tesla knows this. So instead of negotiating incentives after committing capital, Tesla flips the timeline. No deal, no factory. That leverage only works when a company can credibly choose between locations. Tesla can. Multiple regions want the same outcome. Jobs without pollution, stigma, manufacturing without labor volatility, economic growth without legacy risk. Tesla offers all three. That is why this deal looks unbelievable to investors. They are used to companies paying to exist. Tesla is being paid to arrive. And once a company reaches that position, expansion stops being expensive. It becomes strategic. This is not about favoritism. It is about competition between governments, and Tesla is winning that competition quietly, deal by deal. The next question investors are asking is simple. If Tesla can build factories without land costs and tax drag, what does that do to long-term margins? That answer is where this story gets uncomfortable for competitors. The margin math. This is where the numbers stop being abstract and start breaking old valuation models. Factories normally carry three permanent burdens: land acquisition, property taxes, local operating levies. Those costs never go away. They compound quietly every year. Tesla just removed all three. When land costs drop to zero and property taxes disappear, the factory's break-even point collapses forward in time. That changes everything. A traditional factory must recover land purchase costs, absorb annual tax drag, operate at high utilization just to stay neutral. Tesla's factory does not. Every unit produced flows faster toward profitability because fixed costs are radically lower. For investors, this breaks a core assumption. Margins are no longer capped by geography. They scale with volume. When production increases, overhead does not rise proportionally. Taxes do not eat incremental output. Land does not dilute returns. That means each additional product carries higher margin than the one before it. This is compounding at the factory level. Analysts usually model manufacturing margins conservatively because fixed costs anchor projections. Tesla just removed the anchor, and once one factory proves this structure works, the model repeats. Other regions will compete harder, offers will improve, terms will soften. Tesla does not need to ask for free land everywhere. It only needs to show it can walk away. That threat alone reshapes negotiations. This is why investors reacted with disbelief. They are not just looking at one factory. They are looking at a future where Tesla's expansion cost curve bends downward instead of upward. And when capital efficiency improves at the same time production scales, valuations follow. But there is a deeper implication here. If Tesla can build factories without tax drag, what does that do to competitors who cannot? That is where the advantage turns from financial to existential. Why legacy manufacturers cannot copy this deal? This is where the gap becomes permanent. Legacy manufacturers cannot replicate Tesla's no tax-free land factory model for one simple reason. They do not control demand. Most traditional automakers negotiate from weakness. They need a factory to survive. They need local approval to stay competitive. They need incentives just to offset declining margins. Governments know this, so negotiations start with concessions, not leverage. Tesla walks in with something different. Proven demand, guaranteed volume, and a reputation for delivering economic gravity wherever it builds. Legacy manufacturers promise jobs. Tesla delivers entire ecosystems. That difference matters. A government can afford to give land and tax relief to Tesla because the return is diversified. Supplier investment, housing expansion, energy infrastructure, skilled labor inflow with legacy factories. The upside is limited. Lower wages, higher automation risk, declining long-term relevance. So governments hedge their bets. They offer partial incentives, short-term abatements, conditional subsidies. Tesla does not accept those terms. That is why this deal looks impossible to competitors. They cannot walk away from negotiations. Tesla can, and walking away is the strongest negotiating position there is. Even if a legacy manufacturer tried to copy the structure, it would fail. They still carry union rigidity, pension obligations, complex supplier dependence, slower production ramps. Free land does not fix those problems. No taxes do not erase inefficiency. Tesla's advantage is not the deal itself. It is the business model that makes the deal rational for governments. That is why this factory stunned investors, not because it was generous, but because it revealed something uncomfortable. Tesla is no longer competing on cars. It is competing on economic leverage, and once a company reaches that level, the rules stop applying evenly. This is not a one-time win. It is a blueprint, the long game. This is not about one factory. It is about a strategy that compounds. Tesla is turning government competition into a permanent margin advantage, and most investors are still thinking one deal at a time. Here is the long game. Once Tesla proves it can build a profitable factory with no land cost and no tax drag, every future negotiation starts from a higher baseline. Governments begin competing before Tesla even announces interest. Offers arrive early, terms improve faster, conditions loosen. Tesla does not need to demand incentives aggressively. The market does it for them. Each new factory strengthens the next negotiation. Because every completed site becomes proof. Proof of job creation, proof of regional growth, proof of long-term economic impact. That proof lowers political risk for the next government considering a deal. This creates a flywheel. Lower factory costs lead to higher margins. Higher margins lead to faster expansion. Faster expansion increases leverage. Leverage secures better deals, and the cycle repeats. This is how Tesla turns manufacturing scale into negotiating power, and negotiating power into structural advantage. Competitors cannot enter this loop. They are still fighting to preserve margins. Tesla is designing a system where margins improve as it grows. That is why investors were stunned. They were looking at a factory announcement. What they missed was the strategy underneath it. Tesla is no longer constrained by capital, land, or taxes. It is constrained only by how fast it chooses to move. And when constraints disappear one by one, growth stops being linear. It becomes inevitable. The investor wake-up call: This deal forces investors to confront a reality they have been slow to accept. Tesla is no longer valued like a manufacturer, and it should not be analyzed like one. Traditional valuation models assume rising marginal costs, increasing tax exposure, slower expansion as scale grows. This factory breaks all three assumptions. When land costs are zero and tax drag is removed, expansion does not become harder. It becomes easier. That forces a rethinking of long-term valuation. Tesla's future margins are no longer tied to commodity pricing, real estate inflation, local tax policy. They are tied to execution speed. For investors, this changes the question they need to ask. Not how profitable is Tesla today, but how many times can Tesla repeat this structure? Because if this deal is replicated even a few times, the impact compounds aggressively. Lower fixed costs mean faster payback periods, higher free cash flow, greater flexibility during downturns in a capital-intensive industry. Flexibility is power. This is why the market reaction was not celebration. It was hesitation. Hesitation comes when old models stop working. Investors now have to price in a company that builds factories at reduced risk, expands with government support, and improves margins as it scales. That combination is rare. And when it appears, it usually reshapes an entire sector. Tesla is not just lowering costs. It is rewriting the economics of where and how manufacturing happens. This factory announcement was the signal. The message was clear. Tesla is no longer asking how to grow cheaply. It has already solved that problem. The only unknown left is how fast the rest of the market realizes it. Finally, this factory announcement was not about land. It was not about taxes, and it was not about incentives. It was about power. Tesla has crossed a threshold most manufacturers never reach. It is no longer competing for locations. Locations are competing for Tesla. That single shift changes everything. When a company can eliminate land costs, remove long-term tax drag, secure government-backed expansion, its growth is no longer limited by capital or geography. It is limited only by ambition. This is why investors were stunned. They were looking at a factory deal. What they missed was the signal underneath it. Tesla is building a future where manufacturing gets cheaper as it scales, not more expensive. And once that model proves itself, it becomes the standard everyone else is forced to chase. Now here is the real question. If Tesla can build factories with no tax burden and free land, how can traditional manufacturers ever match its margins? Comment Tesla wins or comment government's over. Each I want to see where you stand. And if you want the next breakdown, the one that explains how this model could reshape global manufacturing and which countries benefit the most, make sure you are subscribed with notifications on. Because this was not just a factory deal, it was a warning shot. I will see you in the next one.